What we've used for this video is an extract from a product called the Kit. And this extract is illustrating how a set of financial statements integrate together. What we can see here is we have the three financial statements, the income statement, the cash flow statement, and the balance sheet. Now, each of those financial statements is absolutely key to the work that we do. The balance sheet will give us a statement of financial position. It will state what assets we have, what liabilities we have obligations to, and what equity the firm owes out, I guess, to its shareholders. It is a snapshot. It's produced at one moment in time. The income statement and the cash flow are slightly different in the sense that they report over a period. The income statement is a report over a period, usually 12 months, and it records the revenues and the expenses that the company has generated during that 12-month period. The cash flow statement is a nice, clean source of information that gives us a situation where we just say, well, this is the cash that's been generated, and this is the cash that's been spent. Normally, cash flow statements are split into three sections: the operating section, the investing section, and the financing section. However, what is absolutely key is that people are aware that these three financial statements interact, they flow from one another, they literally bind together. Ultimately, you could almost think of the balance sheet as being the primary financial statement. And what the cash flow statement does, it gives you a very detailed explanation of one key line in the balance sheet, the cash line. Likewise, the income statement could be described as a very detailed explanation of how the retained earnings line within the balance sheet actually works and operates. But what I would like to do is just talk you through the steps of how the financials integrate, and also say to you about how this is absolutely crucially important. It's crucially important in terms of understanding how transactions can affect different areas of a set of financial statements. You can have something happening in the income statement whose impact flows through the cash flow statement that then has a knock-on impact in the balance sheet. Understanding that flow is key. The other main area I would say it is very, very useful is trying to get financial statement models to work. A lot of you will build three-statement financial statements that will produce balance sheet, income statement, and cash flow numbers. Key thing about a balance sheet is that it needs to balance. And trying to get these models to balance can be an absolute nightmare in practice, where you make one mistake with a sign, you omit one side of an entry, and the model actually falls apart. Trying to fix it, well, it could be like looking for a needle in a haystack, or by using your accounting, you can actually pursue what the error is very effectively and think, well, I know how this transaction should have flowed. Let me look at the flow and isolate possibly where the mistake has arisen. But anyway, having a look at the diagram, we've split the process into, I suppose, a series of steps here. This particular diagram is used a lot in our financial modeling work when we build three-statement models with the analysts and the associates. But ultimately, the flow operates like this. We have an income statement. The income statement, as I say, a collection of revenues and expenses. We will produce different types of profit line metrics such as EBIT, EBITDA, net income are going to become second nature to you. But ultimately, it is a record of the economic financial performance for a period. Bottom line of the income statement will state how much profit we have made and ultimately how much profit we've made, and that profit belongs to the shareholders of the business. Now, as you can see from the diagram, we go through step one over to step two. Step two is basically saying, let's keep a record of how much profit we've made accumulated since this company came into existence. And we've called that the retained earnings reconciliation. Ultimately, it is a record of the total amount of profit or loss that is owed to the shareholders. Now, this retained earnings reconciliation links over to the balance sheet, because ultimately, the bottom half of the balance sheet is usually the equity area. The equity area is a record of what we owe to the shareholders. And I use the word owe in quotation marks or inverted commas because whilst it's not an obligation, it is a residual claim to those shareholders. So what we've got there is essentially the income statement flows through to the retained earnings. The retained earnings keeps a record of the total amount of profit or loss that we've accumulated, and that total amount of profit or loss that we've accumulated is recorded on the balance sheet. So we have income statements linking into the balance sheet. Now, at the same time, what will happen is the income statement, whilst it is a measure of financial performance, it's very much based on accounting. Problem with accounting is accounting will try and smooth impacts, There are certain non-cash items that go through an income statement, such as depreciation and amortization. And to a certain extent, this can distort, I suppose, the physical reality of the movement of cash. And that's what the cash flow statement is trying to do. It's trying to literally strip out the accounting to say, given the economics, we'll put that to one side. How much cash have we generated during the year? What have we paid out in that cash? And how flexible is this business? Because no matter how much profit a company generates, if you've got a very profitable company with no cash, that company is not going to survive. So what the cash flow statement does is it derives its cash position using the accounting information in the income statement. And if you have a look at step 4 here, as we transfer from the income statement down to the cash flow, what that transfer is doing is it's stripping out any accounting and trying to get back to the bare bones of what cash have we generated. And as we mentioned, the cash flow statement has 3 sections: investing, financing, and operating. Now, bottom line of a cash flow statement will literally just say, how much cash have we got this year, or how much have we lost this year? Now, working out the accumulated amount of cash that the company has is what the cash reconciliation does down in step 6. All it is cash at the beginning of the year, what cash was generated during the year as disclosed in the cash flow statement, what do we have at the end of the year? If we've got positive cash, it's an asset. Right? That asset is disclosed on the balance sheet, and that's what step 7 is doing. We can see the transfer up to the assets part of the balance sheet, and hopefully our balance sheet is balancing. And the idea is, if we have activity in the income statement that results in retained earnings moving, activity through the cash flow statement should result in the other side of the balance sheet balancing. And what we need to know is why balance sheets balance. We can understand that by really having appreciation of the flow of transactions. So it's not just a case with your accounting of getting the financials to work, but it's actually knowing why those financials work.